Hello, everyone, and thank you so much for joining us today for this very special webinar. As many of you may already know, we recently launched KingsCrowd Capital. After 5 years of collecting data on the online private markets and looking at nearly $38 billion worth of companies within our own rating algorithm, we've gotten to a point where we realized we had an opportunity to create a really unique diversification product for our own customers. We've been listening to you for years, asking for easier and simpler ways to be able to access exposure to these online private markets. And what better way than to be able to invest in a diversified fund product that provides you exposure to 100 of the top rated companies utilizing the KingsCrowd rating algorithm, which, by the way, right now on paper is outperforming the general market by about 30%. Now, obviously, those are paper gains, but it's a good sign that we're helping people identify really interesting investment opportunities. So today, we're going to dive in and learn more about the KingsCrowd Capital's first fund product and teach you more about why you might want to invest in our first fund. So with that, Ahmed, thank you so much for joining us here today.
Thanks for having me.
Now, for those who don't know, Ahmed is our CIO, our Chief Investment Officer. He's the brains and the mind behind our rating algorithm and our investment research team. And he has truly developed the system that we're utilizing here today to create the KingsCrowd Capital Fund product. He's also the person who gives the final sign-off before any investment is made into the fund. So we're going to dive in with him and learn more about what we're up to. But first off, I know I've provided a quick overview, but I'd really love to have Ahmed tell us more about why we decided to actually launch a fund product.
Yeah, the online private market is getting bigger very fast. And there are like thousands of investment opportunities out there on hundreds of platforms covering multiple asset classes. We're talking about startups, real estate, collectibles, digital assets. So there's lots of information to digest to be able to, diligence and research these investments to be able to make an investment decision. It's kind of overwhelming. So it's really hard to keep track of the performance and updates of these companies if you're following them and you want to make sure that you're investing your money in the right place. So our customers actually asked for this. So it came organically that the customers said, hey, I'm overwhelmed with all this. I have the money. I don't have the time. So why don't you create a fund? It was in our product roadmap, but we launched it faster because there's demand for it now. So yeah, after receiving all this feedback, we decided to launch a beta fund to see how that would go and how it would be received by our customers.
So we recently launched our first beta fund. Let's dive in. Tell us more about what this beta fund looks like.
So the beta fund is focusing only on startups for now. So it's not going to invest in other asset classes, the real estate, collectibles, digital assets. We wanted this fund to be also accessible by everyone. By everyone, I mean, legally, we can only accept investments from accredited investors. But we wanted the retail investors, the individual investors. So we created this fund with a low minimum of $20,000 to participate in the fund or to invest in the fund. And this fund is designed as a one-click, as you mentioned in the intro, it's a one-click diversification. So the fund is going to invest in 100 portfolio companies, regardless of the fund size at closing. Those companies will be across different industries. In that sense, the fund will be a generalist fund. However, we're focusing only on seed and early stage investments or startups. And we will keep like 30% of the fund as reserve capital for follow-on investments when those companies raise subsequent rounds.
Got it. So let's talk a little bit about how we came up with the fund size.
Funny enough, by the SEC regulation, if the fund size is less than $10 million, you can have up to 250 investors in the fund. If the fund size is more than $10 million, you can only have 99 investors in the fund. So that's why we decided to make it less than $10 million to accommodate more and more investors up to 250. So it's the SEC regulation, basically.
Got it. And it also allows us to do that lower minimum, right?
Exactly.
Yeah. So, for folks who are listening, I know 20,000 for many can still be a lot of money. Absolutely. First off, if you think about it as individual investments, right? If you're making 100 investments with $20,000, it's actually a relatively small portion for each investment. So it's not a huge amount that you're putting into each deal, which really does provide that diversification. But more importantly, if you look at a traditional venture fund, first off, it's rare that they're willing to even let you be a part of it. And oftentimes they're looking for, $1 million checks plus. So the fact that we've been able to bring it down to 20,000 is one massive step towards democratizing access to fund products. Now, kind of like technology, right? With computers and kind of computing power, right? Hopefully we kind of have these laws where over time, 20,000 becomes 10,000, becomes 5,000, becomes $100, becomes $50, becomes $5. That's the place that we would love to get to, really being able to provide this to everybody. So in time, we're going to continue to work towards those things and hopefully help change some of the rules and regulations around this space to make it more accessible to a larger group of people. But we want to start proving our performance so that we can start taking steps forward in showing that having these types of products for the general public is a really good thing. So anyway, to keep moving on, Ahmed, tell us a little bit more about the terms of the fund and how that works.
Yeah, it's simple. So this is a closed-ended fund. And the term, the period of the fund will be 10 years. And that's usually split into two halves. The first part of it is the investing period, and the second part is called the harvesting period. So in the first 4 to 5 years, you invest in all these companies, and the second half of the fund, as these companies start to get exits or maybe go public, you exit these investment positions and you liquidate you distribute that returns to the investors.
And just for those who don't know the term harvesting, I mean, this literally means giving the time the companies need to build and continue to raise capital and grow the business. So it's literally you make the investments early and then you give them time to actually build those companies and have exits either through IPO or acquisitions. Now, Ahmed, you spent nearly a decade as a venture capitalist working in large venture funds. For those who are wondering how the return works, do they have to wait the full 10 years to see any returns? How does that work?
When the fund term is 10 years, that doesn't mean that they have to wait all this time. It depends on the fund terms and the agreement between the manager, the fund managers, and the LPs. In our case, we decided to distribute returns as exits happen. So whenever we have our first exit, you as investors, as an investor in the fund, you will start seeing returns coming your way.
Got it. And that could be a complex process, especially when you have 100 companies in your portfolio. Do we have a fund admin, or are we managing all of these back office operations in-house?
Yeah, we're partnering with AngelList because many of the accredited investors who are customers at KingsCrowd as well are on AngelList, and we wanted to make it easier for them to sign up for our fund because they're familiar with the platform and they may already have been verified as accredited investors on AngelList. So yes, AngelList is our fund admin and they're managing our back office operations.
Nice. That makes it really simple and easy for investors to both sign up and have the process kind of managed throughout as you look for returns over the longer term. Last question for you here today on our first episode of this series is how much are we charging investors? What does the fee look like?
Well, because we're data-driven and we automated many of our operations, the front office operations, the deal sourcing is automated, the deal evaluation is automated. We're kind of one of the very few VC firms who invest in technology and use technology in their own offices, in their own operations. Because of that, we can scale faster and we are much more cost efficient. So we decided to charge half of the traditional venture capital fees, which is usually 2% management fees and 20% carry or performance fees. In our case, it's only 1% management fees and 10% carry.
I like to call it venture at scale. I think it's a pretty cool innovation for our industry. So this has been really helpful. For everyone who joined today, in our next episode, what we're going to be discussing is how our data and ratings actually work to identify winning investment opportunities. We're going to start deploying capital this month. So you still have time to join the fund. We'd love to have you be a part of it. And of course, be sure to join us for the next episode of our webinar series to learn more about how we're actually identifying, due diligencing, and investing into these really exciting investment opportunities and building out this really unique, fun product. If you want to get one-click diversification into 100 startups, you can join us now at kingscrowd.com/capital. You can either invest directly or you can schedule a call with Ahmed himself to learn more and get more details on our fun product. Again, that's kingscrowd.com/capital. And we hope to see you on the next episode of our webinar series. Take care, everyone.